Right, so let's talk about equal highs and equal lows. Now, equal highs and equal lows works just like inducement, but it's a liquidity class, okay? It's liquidity. And in my own opinion, in between the inducement and equal highs and equal lows, the market tends to respect more of the equal highs and equal lows. And they work almost the same way, okay? So let me explain to you what I mean. Now, for the inducement, you simply created an inducement class like a mini pullback, and then you wait for it to do what? To come back into it, sweep the inducement before you finally move. And also, that's how the inducement work. You wait for the market to come and sweep the level before you now finally enter for a buy. But equal highs and equal lows work just like that, but in a very simple, different way. So the market goes up, comes back down, go up a little bit, and create an equal low like this before going up. Now, what happened is this: when this equal low is created, it was just like an inducement. All you just want is just let market do this kind of thing, right? You want the market to come back down, sweep the equal low before finally continue. Yes, this is exactly what you want to do. This is how the equal lows work. Same thing with the equal highs, right? Same thing with the equal highs. Market comes back down, goes up, creates a level of rejection that looks like a double top, goes down, see that level, and then continue all the way to the downside. Which is this. So this is equal highs, this is equal low and equal highs, and I use my symbol. I use the liquidity symbol for this. I use the liquidity symbol for this. And then for the inducement, I use IDM. This is how I do it, right? So now, what about in a case where you have on a simple impulse leg, you have both the equal high, you have both equal highs and equal lows, or you still have with the inducement alongside? What do I mean? Let's say you have a move upward like this. Let's say you have a move upward like this, and you had an inducement below here. So you had equal lows like this. My question is, which one do you think the market will want to respect? The equal lows or the inducement? Let me give you 10 seconds to answer that. Which one do you think the market will want to respect? The equal lows or the inducement? Have you gotten your answer? All right, let me tell you the answer. Now, if you look at this very well, you discover that the equal low seems to work like a level of support, which means that there are more people pushing this market than just this level. This level was pushed just once, right? But this one was pushed, I was respected how many times? Twice. So respected twice, this gives this place an advantage. Which means this is the price level that people do not want it to pass. This is the price level that people do not want it to pass. There are more buyers on this level. There are more buyers on this level compared to the inducement. So my answer is, if the market sees a level of equal lows and inducement, it has 80% chance that to respect the equal lows and forget about the inducement and then continue. You get that now? There's an higher probability that you respect more of the equal lows or the equal highs compared to if it has the inducement alongside. Are you getting it now? Now, what about if there's an inducement? This one, in this case, now there's an equal low before the liquidity. What about if it is the other way around? We have equal lows like this, and then inducement before we now have this move. What about if we have this? What about if you have this instead? Which one would the market want to respect? I will still go for the equal lows. I'll still go for this one. I will still prefer the equal lows or the equal highs compared to the inducement. Or if there is no equal lows or equal highs, I'll just use the inducement alone. So I see that it's very, very simple. So let me see if I can find an example for you on the chart. All right, so I want to show you an example on the chart right now. So now, this is volatility 10, right? So let's look at for the trend. You can discover this is a downtrend, obviously. Now, we have an impulse move from here all the way down here. You notice that? Now, for this impulse move right here, so let's mark out our inducement. So I'm going to mark out the inducement right here. We have an inducement on this level. Let me do this again. We have an inducement right here, downside, right? Now, do you notice why the market was coming back down when it got to this level? Did you notice this? That is, what's that? What do we call this? This is equal highs, right? So market created inducement here, IDM, and then also created equal highs here. All right, so once the market got to the major low, which is this low here, once the market got to the major low, now look at it. While it was pulling back, where did it pull back to? Why did you not go for the inducement? Because of why there's an equal low here. So the market tends to respect more of the equal lows. So it came back down here, inducement, came here, created equal highs, and respected the equal highs before coming back down. Right? It has already swept it. If it has not swept it before, why the market is making a pullback, it would have gone for it. So now the market is going to be making a pullback and then go for this level before continuing all the way down. Are you getting it? So the market tends to respect more of the equal lows or equal highs compared to the inducement. Does that make sense? Does that make sense? Does that make sense? So that's how the inducement and the equal highs and equal lows work. So whenever you are marking your trend, your structure, always watch out for the inducement. Wait for the market to sweep it or the induce or the equal highs or equal lows before you enter for your trade. So that will be all for the liquidity advanced class.